that I don't own gold because I think it might go through 2,700 or for that matter, 3,000. I own it because I'm afraid it's going to go to 9 or 10,000. Will it do that in lockstep as a straight line? No. If you're a trader, if you're somebody who's afraid of volatility, if you can't afford to remain long, by all means, take trading profits. That's not how or why I own gold. I own gold to maintain my purchasing power. I believe the past is prologue. I believe that the dollar will buy you 75% less in goods and services in the 10 years coming relative to today. Why do I believe that? The on-balance sheet liabilities of the U.S. government are $35 trillion and counting. The off-balance sheet liabilities of the U.S. government are $100 trillion and counting.
Gold prices increased on Tuesday, hovering just below Monday's record high of $2,740. Investors remain cautiously optimistic, with trading confined to a narrow range, indicating potential volatility shortly. The recent rise reflects a gain of over 30% since the start of the year, marking a significant milestone for the commodities market. Heightened concerns over global geopolitical tensions, uncertainty surrounding the U.S. elections, and the likelihood of central banks lowering interest rates are fueling increased demand for gold as a safe haven asset. RickRule, president and CEO of Rule Investment Media LLC, believes that gold might surpass $2,700 or even $3,000. But his primary reason for owning it is the fear that it could eventually rise to $9,000 or $10,000. Over the past 24 years, gold has increased by about 8% annually on a compounded basis, helping to maintain purchasing power, which is the key reason for his continued investment in the metal. Rule warns that the U.S. dollar could lose up to 75% of its purchasing power over the next decade, making gold a critical hedge against that potential devaluation. The strength of the U.S. dollar has been a prominent topic in recent years, particularly since 2009. While many Americans have experienced the impact of a weakening dollar through inflation and reduced purchasing power, widening trade deficits, a staggering $35 trillion in national debt, and the steady erosion of the dollar's purchasing power have been central arguments driving the gold bull thesis. As for the long-term outlook, RickRule suspects that the next 10 years will be highly favorable for gold. Drawing on historical patterns, he compares the current situation to the 1970s, when the U.S. addressed its debt and deficits by significantly devaluing the purchasing power of the dollar. Rule believes a similar scenario could unfold, where the U.S. government inflates away its financial obligations, further boosting the value of gold as a hedge against the dollar's decline. Stick around for the full video, and if you find it helpful, make sure to like and subscribe. We're excited to see more of you joining our community, with only 20% subscribed so far. Help us hit that 1,000 milestone.
I think gold keeps going. Whether or not you should reduce your exposure really depends on you. I've said on your show before that I don't own gold because I think it might go through 2,700 or for that matter, 3,000. I own it because I'm afraid it's going to go to 9 or 10,000. Will it do that in lockstep as a straight line? No. If you're a trader, if you're somebody who's afraid of volatility, if you can't afford to remain long, by all means, take trading profits. That's not how or why I own gold. I own gold to maintain my purchasing power. By my measure, gold didn't start moving 3 years ago. Gold started moving in the year 2000. If you look at the 24 years that we've been through, gold has increased in price by about 8% compounded a year for 24 years. Gold has maintained my purchasing power, which is precisely why I own it. Is the pace of the escalation of the gold price picking up? Yes. And in the face of political pressures on the Fed to lower their interest rate, which is a different way of saying devalue the yield on the U.S. dollar, should gold continue to accelerate? Yes, if all other things remain equal. Again, though, your technique with regards to gold, your strategy with regard to gold, will relate more to you than to gold.
The rise in gold prices has not occurred in isolation. Silver, often regarded as gold's younger brother, has also experienced a notable surge. The metal has reached its highest price level since 2012, driven by increased demand for safe haven assets amid growing economic uncertainty. While silver has more industrial applications than gold, its status as a precious metal makes it equally desirable during times of economic volatility. According to RickRule, in a precious metals bull market, gold sets the initial trajectory, with the first wave of buyers motivated by fear. While he allocates a larger portion of his net worth to gold for insurance purposes, Rule views silver as a more speculative asset. He notes that around 2.5% of his equities portfolio is invested in silver equities, which comes with higher risk. However, He is prepared for this portion to grow significantly, potentially increasing from 2.5% to 20%, based on the historical performance of silver equities in past bull markets. Now, let's redirect our attention to a video.
Momentum in a gold bull, in a precious metals bull market is set by gold. The first buyer is the fear buyer. And it's only after gold has established the precious metals narrative among generalist investors that silver begins to move. But when silver does begin to move, it goes further and it goes faster. Whether or not we have reached this tipping point or not is a subject open to conjecture. But the performance that we've seen thus far, the relative performance between gold and silver, has been borne out in prior bull market cycles. I am not sure why this set of circumstances occurs. I can just tell you from observing 4 prior precious metal cycles that does seem the way it performs. Perhaps when the generalist investor gets attracted to the precious metals narrative and comes down into the space, that the higher historic volatility of silver and the lower unit cost of silver attracts them. I have much more of my net worth in gold because I own it for insurance purposes. I like to make money. I don't need to make more money. And gold and silver is a more speculative asset. I have about 2.5% of my equities portfolio in silver equities, where I'm exposed to very high risk. It wouldn't surprise me to see that 2.5% of my portfolio turn into 20% of my portfolio if the performance of the silver equities mirrors the performance of silver equities in past bull markets. But at 71, I'm a little more risk averse than I was earlier in my career. And the consequence of that is that I'm personally overweighted gold because I have a desire for safety more than a desire for speculative gains. By the weight that the broad market has involved in the sector, I think you'll come to some startling conclusions. The market share of precious metals and precious metals-related assets relative to other asset classes in the North American market, the U.S. and Canada, is that the market share of gold and precious metals relative to all assets available for savings and investment is only 0.5%, which is to say that 0.5% of North American investment and savings assets are denominated in gold and silver. The 4-decade mean market share was 2%. So gold doesn't need to win the war against the U.S. dollar. It doesn't need to win the war against the euro. It needs to lose less badly. If we had reversion to mean, demand for precious metals would quadruple. Relative to that, which is to say relative to the market share, my own allocation in my own portfolio of physical gold and gold shares relative to other asset classes exceeds 10%. So by conventional measures, I'm 20 times overweight. Maybe that puts the question in context. I suspect that you have some listeners who are 100%, which I would consider to be substantially overweight.
The new record in gold prices is driven by a combination of economic and geopolitical factors. Rising inflation and global tensions have prompted investors to turn to safe haven assets, pushing gold to unprecedented levels. With forecasts suggesting prices could climb to $3,000 per ounce by 2025, gold remains a crucial investment choice for those seeking stability in an uncertain world. The future cost of gold will continue to be closely tied to inflation trends and geopolitical risks, reaffirming its central role as a store of value in the years ahead. Do you consider gold a better hedge against inflation compared to other investments? Why? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.